Now that we understand what unit trust is and the types of trust that one can invest in, one could be curious to find out how money will make a good return. When putting money into an investment scheme, the most common question for any investor is, where does the money go and how will it generate a positive return?
So when you deposit in any unit trust, or rather if you invest in any unit trust, the money first goes to the custodian. So the custodian, this is the person who holds your money, awaiting instruction from the fund manager or the asset manager on where to invest.
A custodian is a company, usually a bank, approved by the Capital Markets Authority to safeguard the unit trust's funds. After the money goes to the custodian, the next destination for your money will depend on the type of unit trust you choose to invest in. For example, treasury bills, fixed deposits, shares, among others.
In the case for money market, this is treasury bills and fixed deposits. So when we as the fund manager or a fund manager invest in the treasury bills, they earn an interest. So currently, the treasury bill rates on an annual basis right now are at 12%. So we invest in the treasury bills. Then once the interest is paid to us, we distribute to the clients on a monthly basis.
Treasury bills are a secure, short-term investment that fund managers invest your money in. And depending on the treasury bill issued by the government, it can mature by either 91, 182, or 364 days. The interest rate the money market fund earns will therefore depend on the treasury bill interest rates. For fixed deposits, the fund manager puts a lump sum of money in a bank account for a certain period of time at a specified interest rate.
So we approach a bank and tell them we have X amount of money and would want to fix a deposit with you. Say 3 months, 6 months, 12 months. Which rate are you going to give us at the end of the period? They would come and tell us 10%, 12%, and from that, after the maturity of the fixed deposit, they give us the interest plus the principal, which we distribute to clients.
For equity fund, the money invested in shares can earn via dividends or capital gains.
It's at the discretion of the fund manager to pick the shares which offer the best returns based on the fund manager's research. So dividends, you've given us the money, or rather you've invested in the equity fund. You bought shares, say your Safaricom, your NCB on the Nairobi Securities Exchange. These companies pay out a dividend. Most companies pay out semi-annually, twice in a year. So once they pay out the dividends, they pay the dividends to the fund manager, which we in turn pay out to our clients. So that's one way. I'd also mentioned that for equity fund, it has a daily price. So in my early example, I'd said if it was at 100 shillings, you bought it today at 100 shillings, tomorrow it's trading at 1 or 2. Upon exit, if you're going to exit, say in 2 days' time, a month's time, dependent on the price that it will be at that time, you will have made that difference of the price you bought it at and the price you sold it at.
Next, your money will go to a fixed income fund or bond fund, where fund managers invest in corporate and government bonds in the secondary market of the Nairobi Securities Exchange. A corporate bond is a type of debt security issued by a corporation and sold to investors. And the maturity period for this type of bond can be short-term, which is less than 3 years, medium-term, which is 4 to 10 years, or long-term, which is more than 10 years. On the other hand, treasury bonds are units of government debt that offer investors interest payments every 6 months throughout the bond's maturity. They are offered for a set number of years, ranging from 1 to 30.
Going on to the bond fund, you also earn monies twofold. This is you earn one via an interest, because bonds usually pay out interest semi-annually. Once they pay the fund manager the interest for that period, say for that half year, we distribute it to the clients. And also you find that for the bond fund, it also has a daily unit price. So you find that it's the same thing as equity fund, find that today it could be trading at 105, tomorrow at 106. So upon exit or upon selling the unit of the bond fund, you can make a profit based on that difference of price.
Finally, your money will go to a balanced fund, which is a combination of two asset classes. A fund manager can invest in either bonds and shares, while in another, they can invest in treasury bills and shares.
Going on to the balance fund is the best of both worlds. Gives you an interest payment on one end. Now, this other end, it also gives you the scope for capital gains, because when we say capital gains, the share values fluctuate quite a lot. In a short period of time, you find that even within a week, you might find a share might have appreciated by more than 5 shillings. And this gives you a good room for capital gains, in the sense that if at the beginning of the week the share was at 50 shillings, at the end of the week it's at 55, it's very easy to realize that difference in the form of capital gains.
To realize the highest gains, most fund managers have a research team. The team analyzes the market conditions before investing in any asset to ensure that it is the right time to buy.
So what usually happens, each fund manager has a research team and monitoring market conditions. So when I say market conditions, this is the Nairobi Securities Exchange, this would be the bond market. That is their bread and butter. They do this on a day-to-day basis. They do this to advise the portfolio managers on the best course of action, to ensure that the fund value, when I say fund value, this would be the fund value of the bond fund, the money market fund, the equity fund, to make sure that the fund value is growing. So yes, we do monitor, and we have a dedicated team that actually looks into that to be able to inform the decisions of the portfolio managers.
Now that we know where your money goes, in the next video, we'll find out what can affect your earnings depending on the unit trust you invest in.